All right, David. Well, we're going to have to contact the White House and get the president on board. He can't be making major announcements on Wednesday afternoon after we've recorded our show for that week. But that's exactly what happened. He said, well, all these tariffs, actually, if you're willing to do a deal with us, never mind, we'll back off. China, on the other hand, we're going to keep clubbing you over the head. But David, you sent the team a notice about how the S&P then had its third best day since 1950. But then just this morning, before we sat down to do this show, you sent the team a chart from J.P. Morgan saying the S&P could fall to 4,000. What is happening in the markets, David, and how do you see this playing? Why don't you remind people what President Trump did last week on tariffs, and then tell us where we go from here.
Yeah. So we said be cautious going into the announcement. We knew there'd be an announcement, but we didn't know what it would be, and so basically you've had all kinds of rhetoric with the announcement that they were laying out all these tariffs, and the markets got clobbered. Well, then, go a week later and they announce, hey, just kidding, at least for the next 90 days, and we're not going to tariff everybody. And the market shot up, and boy, did it shoot. I mean, the Dow was up over 2,400 points. The S&P had the third best day since 1950, right? And I'm a data geek early in the mornings going through this, so I went back and looked at every day for almost the last 75 years, and the only other 2 days that were bigger, there was an 11% up day and a 12% up day. We went up 9.5% on that day last week, right? Those other 2 days, guess when they came, Chip? October of 2008.
Oh, great recession.
So gigantic up days do not come during upswings or uptrends in the market. They come in bear markets. In other words,
bounce back.
So these are what we call bear market rallies, and it's usually not an all clear sign, and usually actually it's a warning sign. If you hadn't already taken notice, you might have an opportunity to de-risk or de-lever your portfolio in a way that has less risk. And of course, we saw the markets fade from that high, and we think they're going to continue to fade here in the near term for sure. And then we saw this article from today of J.P. Morgan saying, hey, worst case scenario, you can see the S&P go all the way down to 4,000. And I'll give you an understanding of where we are today. That's another 25% down. We've already lost about 20%. So that would be pretty brutal.
That'd be a shockwave.
Yeah. And it's possible. It's in the cards. In fact, we have it showed on the charts. It's possible to go all the way back to 3,300, believe it or not. But don't necessarily think that's what's going to happen. But again, the point of this is, are you prepared either way? If you've worked your entire working career, 30, 40, 50 years to accumulate this nest egg, are you just going to take it and sit there and hang in there? That's the advice that your broker may be giving you. Just hold on. It's a long-term game. Or do you have somebody proactively de-risking your portfolio the closer you get to retirement so that this drawdown would not affect you entirely? In other words, our retirees are not susceptible to 25, 30% drawdowns, simply the way we allocate their portfolio. So understanding how to risk manage your portfolio when you're taking income, you really need to make sure you're not fully involved in
So
risk.
There are strategies to address whatever scenarios present themselves, but you got to be ready to pivot. You got to be ready to make a move, make a change.
Absolutely. And on top of that, this presents amazing opportunity. So for dollars that we want to be aggressive with, now that's a bucket of money. Most clients, if they're not going to spend the money, Chip, for 5 to 7 years out, we could be a little bit more aggressive than the money we would need, this year, the next couple of years, et cetera. So you have to understand how to segment your dollars into when you would access them. But there's going to be an amazing buying opportunity at this market bottom whenever it becomes, especially if you have dollars in tax-free accounts like Roth IRAs. Because if you go in there and purchase something, and as it rebounds and if you hit the proverbial home run with it, it's tax-free if you follow all the rules. So again, there's so much to this, but most people are set in their ways. Somebody, from a national firm, put them in a bunch of mutual funds and just told them to hang on. And that is not proactive financial planning. That's not proactive tax planning. And that's certainly not holistic financial planning in my mind.